Welcome to Tax Breaks. I'm your host, Kelly Phillips. I'm a senior writer for Forbes, and you might have seen me around the web as Tax Girl. I'm also a tax attorney, and I work with tax professionals and taxpayers like you every day. There's a lot to talk about, so let's get started. That sound you heard last week? That was the sound of millions of tax preparers and taxpayers breathing a sigh of relief now that tax day is over. April 15 was tax day for most of the country. Some exceptions apply, but that hasn't always been the case. The U.S. income tax system has changed quite a bit over the years, and that includes more than the due date for Form 1040. Statistically, most taxpayers have used a tax professional so far this season. Those who self-prepared their returns had a variety of options, including Direct File, but that won't be the case next year. The Trump administration is planning to eliminate the IRS Direct File program. While Republican lawmakers had previously opposed the program, the free tax software program had been marked as safe for the 2025 season, with now Treasury Secretary Scott Bessent committing to the program during his confirmation hearing. Quote, "I will commit that for this tax season, Direct File will be operative," end quote, Bessent said. However, less than 48 hours after the end of the regular tax filing season, word circulated that the program would be axed. Amanda Renteria, who serves as the Chief Executive Officer for Code for America, a civic tech nonprofit, called it, quote, "a dark day for Americans who want a simple, free option to file their taxes electronically directly with the government," end quote. She continued, quote, "The decision to kill Direct File comes at a critical moment when faith in public institutions is already at historic lows. This isn't just a step backward for tax administration. It's a betrayal of public trust at precisely the time the government should be demonstrating its ability to deliver basic services effectively," end quote. No matter how you filed your taxes this season, you need to keep great records. But for how long? Some taxpayers like to hang on to every piece of tax-related paper, from receipts to returns, forever. Others do exactly the opposite. They shred and purge immediately. When it comes to tax records, which is better? For tax purposes, you need to find a middle ground. And that middle ground is somewhere more precise than between forever and immediately. While it's true that you want to keep essential records, don't be afraid to toss out whatever you don't need. The general rule is that you should hold on to your tax records and the supporting documentation until the 3-year statute of limitations has run. That's the time that the government has for challenging your return. Supporting documentation for your tax returns includes not only Forms W-2 and 1099, but also credit cards and other receipts, invoices, mileage logs, copies of checks, proofs of payment, and any other records that support your income, deductions, credits, or tax breaks that you reported or claimed on your tax return. Of course, exceptions apply. The government gets longer to go after you for fraud and failure to file, for example. And there may be non-tax related reasons, like a mortgage or student loan, to hold on to those records. Find out what works for you and follow through. With tax day mostly in the rearview mirror, most taxpayers were likely looking for a break. My family celebrated with an Easter egg hunt. Yes, my kids are older, but they're also super competitive and they like candy. But my mom took a tumble just before joining us last week, so our gathering was a bit smaller than anticipated. There was, however, still candy. I hope you enjoyed something similarly relaxing-ish. Speaking of candy, across the pond, legal minds were debating whether Mega Marshmallows, described as oversized fluffy marshmallows, should be classified as edible confectionaries or candy, thereby subject to the standard UK VAT rate of 20%, or classified as a culinary ingredient that qualifies for a VAT exemption. You can think of VAT or value-added tax as sort of like a sales tax. The case is His Majesty Revenue and Customs versus Innovative Bites Limited, but you may have heard of Innovative Bites by a different moniker, the Great British Marshmallow Decision of 2025. The final ruling? By statute, confectionaries are subject to the standard VAT rate, while food ingredients are 0 rated. The result is that marshmallows eaten out of the bag with fingers are presumptively confectionaries, while those toasted over a heat source and used in the making of s'mores receive a dubious VAT exemption. Mega Marshmallows were, the court ruled, a confectionery, no VAT exemption allowed. Now, let's answer a taxpayer question. The taxpayer asked, I recently got into a car accident and I received some money from the insurance company. I put the $11,000 into my savings account. I'm on a payment plan to pay off back taxes. Can the IRS take that money from my savings to pay off the debt? Here's my answer, with a little bit of an explanation first. One of the ways the IRS ensures that it gets paid is through a levy. A levy is a legal seizure of your property. It's often confused with a lien, but they are very different. A lien is filed against you to act as security. For example, an IRS lien will prevent you from selling a significant asset like your house and taking the proceeds without first paying the IRS. In comparison, a levy is the actual taking of your property to satisfy your tax obligations. A levy is never a first step. The IRS gives you the opportunity to resolve your tax debt through a lump sum payment, an installment plan, or another arrangement. But here's where the reader gets some good news. Typically, so long as you are making regular payments on an installment agreement, the IRS won't levy your assets or garnish your wages. However, it's important to make your payments as scheduled, file your tax returns on time, and otherwise comply with the terms of your installment agreement. If you default, all bets are off, and the IRS can resume collection activities, including levies, which again is seizing your assets. Note, however, that your tax return could still be seized or taken and applied to your outstanding balance, even if you are making regular payments on time. That said, even with the payment plan, the IRS may choose to keep a federal tax lien in place. The IRS will release the lien once you pay off your debt. For certain kinds of taxes, the IRS will withdraw the lien if you enter into a direct debit installment agreement and meet certain other conditions. If you have a tax question or matter that you think we should cover in another episode, please let us know. You'll find more information in the show notes. Of course, if you follow me on Forbes, you know that I love looking at statistics and I enjoy a good chart or map. This week, I'm focusing on the IRS website. IRS numbers from the 11th week of the tax filing season, that's the week ending April 11, 2025, confirm that tax filings are lagging behind the numbers from last year. That isn't likely to turn around. Just a few days before the end of the filing season, the number of tax returns received dipped again, a trend that hasn't changed since the tax season opened on January 27, 2025. In January, the IRS noted that it expected to receive more than 140 million individual income tax returns by tax day. So far, the IRS has received 117,588,000 individual income tax returns as of April 11, 2025. That's compared to 119,592,000 as of April 12, 2024. The dip is 1.7%, with nearly 2 million fewer individual income tax returns filed to date as compared to 2024. The data that includes the last day of the filing season, April 15, 2025, will be available on April 25, 2025. The IRS reports the filing data for each week based on the prior week's numbers. Notably, web visits to irs.gov continue to lag far behind last year's numbers. There have been 296,470,000 visits to the website as of April 11, 2025, compared to 533,981,000 visits by April 12, 2024. Those numbers reflect a drop of about 45%, but you won't see that statistic on the IRS website. For most of the season, the percentage was calculated. But now, a footnote on the IRS website reads, quote, changes were made from 2024 to 2025 in the analytics methodology used to evaluate the number of visits to irs.gov. Previously, a session-based approach was used. In 2025, an event-based model is being used. As a result, comparison of data sets from year to year should not be made, end quote. A session-based approach tracks users within a defined timeline and includes metrics like page views, bounce rates, and traffic source. If you have a blog or a website, this is akin to what you would learn from a platform like Universal Analytics. In contrast, an event-based approach tracks the kinds of actions that a user would take, like clicks and form submissions. This is similar to what you'd learn using a platform like Google Analytics. I've suggested that the dip could also be attributed to a slowdown in content on the website. It likely won't help that the IRS's Chief Information Officer will leave his position at the end of the month. Rajiv Uppal's departure follows several high-profile defections from the tax agency since the beginning of the year. Uppal's position was created as part of former IRS Commissioner Danny Werfel's plans for a new leadership structure at the agency, and his domain included the IRS Information Technology Division, previously touted as a key area of focus for the agency. Now it's time for a little tax trivia. According to the IRS, the average individual taxpayer spends how many hours preparing their individual returns? Your choices are A, 5 hours, B, 13 hours, C, 35 hours, D, 72 hours. I'll give you a minute. The answer is B, 13 hours. The estimated average time burden for all taxpayers filing a Form 1040 or a Form 1040 SR, that's for seniors, is 13 hours, with an average out-of-pocket cost of $290 per return. This average includes all of the associated forms and schedules and taxpayer activities like record keeping. Non-business taxpayers have an average burden of about 8 hours and an average cost of about $160 per return, while business taxpayers have an average burden of about 24 hours and $620 per return. You're considered a business filer if you file a Schedule C for self-employed and business owners, Schedule E for income from rental real estate, royalties, partnerships, S-corps, estates, trusts, and residual interests in real estate mortgage investment conduits, or REMICs, Schedule F for farming income, or Form 2106, the Employee Business Expense Form. If you file any of those together with your 1040, you're considered a business filer. Now it's time for a deeper dive, and it's a look at whether certain kinds of IRS penalties can survive a taxpayer's death. Family members often want to know what happens when a spouse or parent dies with outstanding tax obligations. That's a complicated question, but a recent decision out of the U.S. District Court for the Southern District of New York has made clear that FBAR penalties accrue on the date that the form is due, but fails to be filed, and not when the IRS assesses the penalties. That assessment could happen after the taxpayer has died, and the court has found that death does not end the obligations or render them excessive under the Eighth Amendment. The case revolves around David Benishai, a U.S. citizen who held financial interests in multiple bank accounts in Israel from 2004 to 2010. Benishai failed to file timely FBARs. Under the FBAR rules, each U.S. person with an interest in, signature, or other authority over one or more bank securities or other financial accounts in any foreign country must file an FBAR if the aggregate value of such accounts at any point in the calendar year exceeds $10,000. In other words, if the total of all of your interests in foreign accounts in which you have an interest reaches $10,000 or more at any point in the calendar year, you may need to file an FBAR. That applies even if you've been faithfully reporting the income on your federal income tax return, and even if you've never, ever repatriated a single dollar to the U.S. It also applies even if the account produces no taxable income. Benishai didn't timely file his FBARs, but he did file delinquent FBARs, and he agreed to extend the statute of limitations for the IRS to assess those penalties. He passed away a few months before the IRS finalized its assessment. Benishai's estate, administered by his wife, Hannah Hendler, challenged the assessment of non-willful penalties, which the IRS had assessed at $10,000 per report. The estate argued that the FBAR penalties could not be enforced after his death, that the statute of limitations had expired, and that they violated constitutional protections. The court found that the FBAR penalties are primarily remedial, which means they are designed to compensate the government for the cost of investigating noncompliance and enforcing tax collection, and not purely punitive or designed to punish the taxpayer. This is consistent with the court's approach in Bittner, a Supreme Court case that held that the maximum penalty for non-willful failure to file should be calculated per report and not per account. The result is that when a penalty is remedial in nature, the penalty can survive the taxpayer's death. Now for something a little more brief, some quick tax and accounting newsmakers. The American Institute of CPAs, or AICPA, has signaled its strong support for bipartisan legislation establishing the accounting profession as a career pathway through science, technology, engineering, and math, or STEM. H.R. 2911, the Accounting STEM Pursuit Act, introduced by Representatives Young Kim out of California and Haley Stevens out of Michigan, would allow K-12 grant funding to be used for accounting education, with a focus on improving access for underrepresented students. The city of Venice, Italy, will charge day trippers an arrivals tax for the second year. The measure is designed to combat overtourism. Visitors who are not overnighting pay 5 to 10 euros, that's about 6 to 11 US dollars, to enter. Venice collected 2.4 million euros during its 2024 pilot program, but the cost for the new system totaled 2.7 million euros. This year, however, the city expects a surplus. Pedestrians in Seattle were startled to hear crosswalk signals broadcast recording purporting to be Amazon founder Jeff Bezos criticizing local tax policies. One message reportedly said, quote, "Hi, I'm Jeff Bezos. This crosswalk is sponsored by Amazon Prime," with an important message. Please don't tax the rich. Otherwise, the other billionaires will move to Florida too, end quote. The recordings, which appeared to be a form of political protest, targeted multiple intersections in Seattle's tech-heavy South Lake Union neighborhood and the University District. And that's a wrap. Thanks to all of you who continue to watch, comment, and share the show. I'd love to know what you thought of this episode. You can send your feedback to me at kerb@forbes.com. And if you liked it, please share. You can find a link to the audio of each episode at Forbes.com. Thanks for listening, because paying taxes is painful, but hearing about them shouldn't have to be.